I see a lot of crazy credit reports where you can tell from looking at it because there's so many accounts that have been, charged off and, in collections. Like some people just don't pay their bills.
Right.
And if I'm doing a lease option, I'm not going to do it with a person like that because God only knows where they're going to land in 2 years, even if they're kind of borderline compliant.
Welcome back to Sub 2 Investor. In this episode, I'll be kicking off a new interview series where I'm going to be bringing folks on within the real estate, particularly creative finance industry, to be having conversations about all things creative finance, real estate investing. Basically, it's a little bit of a selfish project of mine to get some of the best people that I think onto this channel to have just conversations about what they do, whether they're actual investors building a portfolio of cash flowing properties, or if they're involved in the space in some other capacity. There's all sorts of people that are very important and valuable resources to get to know who they are and to learn from. And so in this episode, I'll be kicking things off with Dan Deppen from Call the Underwriter. And Dan's business, Call the Underwriter, is a very important one if you are interested in the world of seller financing, particularly selling with seller financing. In my opinion, that is the magic sauce of how to actually generate income from real estate like today, like liquid cash flow income that you can have in your bank account if you started investing today. Seller financing is a key strategy, in my opinion, to be able to accomplish that. So if you're going to be selling properties with seller financing, it is of crucial import that you understand what compliance you need to have in your business. There's laws, regulations that touch on seller financing and have an impact for people like you and me who sell properties with seller financing. And if you're ignorant of those laws, then you might run into problems down the road. And so you certainly want to be knowledgeable. This is a very important episode. So stay tuned and I hope you enjoy. All right, well, welcome back to the Sub 2 Investor channel. Today I have a very special guest I'm very excited to have with us. Mr. Dan Deppen is the owner of Call the Underwriter. He is an experienced note investor, creative finance investor himself, and he runs and operates a business that everybody watching this channel should certainly know about. So welcome to the show, Dan.
Yeah, thanks for having me on.
Well, let's get into what it is you do with Call the Underwriter. I have a feeling that a lot of folks who follow my channel probably have no idea about underwriting, using an RMLO, even the whole world of note investing, which I want to kind of just touch on in a little bit. It's something I talk about sometimes in my content, in my videos, but it's not something that I consistently harp on. So I feel like let's just start out this conversation with the bare bones. Like, what is it that you do over at Call the Underwriter?
Yeah, so at Call the Underwriter, we help investors who are creating notes. So there's kind of the creating note side of the world, and then there's the buying note side, which we can get into a little bit later. But when it comes to creating loans, it's kind of a subject that there's not a ton of information out there on. And I would say like the vendor, base to support that is not really where it should be, given like the actual size of the market. Like I know Fred and Tracy really estimate, like from going through county records, there's probably a good, 100,000 plus notes created every year in the US. It's actually probably a lot more than that because a lot of them don't necessarily get recorded. But when an investor is creating a loan on seller finance, there are like a couple things that are important. Like one, no matter what, is vetting the borrower and understanding that your borrower has the ability, that is a good borrower, is credit worthy, is going to have the ability to repay the loan. And then if it's and I have a because there's a lot of like different kinds of loans you can create, but if you're creating an owner occupied loan where it's basically a consumer loan, then there's a number of compliance things that you have to pay attention to. And that's one of the big things that we help investors with as well. So, for example, people have probably at least heard of Dodd-Frank, which, among other things, says that if you're creating a loan and it's the borrower's primary residence, and if they can't afford to pay the loan, so they're going to potentially get foreclosed on and lose their primary residence, then you have to validate ahead of time that they have enough income to repay the loan. Which, I mean, a lot of these rules actually kind of make sense if you think about them. Although the other thing I would point out with like Dodd-Frank is a lot of these consumer rules that like can sometimes like cause a lot of fear, and people get kind of, I don't know, they get kind of worked up about them, but when they don't understand how they work. In my view, having like really gone deep in this stuff for the past year, it's really all stuff I want to do anyways as an investor. So you know, you don't really need to be too afraid of them. Like I said, like for us, like we're set up to handle all that stuff. It's pretty easy and turnkey. So you don't have to worry about spending a year figuring everything out, you know, like I did. But, you know, for the compliance side, like Dodd-Frank is kind of the big one. And then there's also this thing called TRID, which just basically just means that you've got to send a loan estimate to your borrower 7 business days before you close, and a closing disclosure 3 business days before you close. And that gives the consumer, right, the the ability to go through and read all the fine print, you know, should they so choose.
Yeah. So basically, to get down to brass tacks here, the whole reason that Call the Underwriter exists, that folks like you who are doing this RMLO, I'll have you define that here in a second. But the whole point is compliance, right? Compliance with law, with legal stuff. If we're going to go out buy a property, whether it's subject to, which is what a lot of people watching this channel are interested in, or even if you buy it on seller financing, or even if you buy it cash, rehab it, refinance it into a DSCR loan, doesn't matter what kind of financing. But if you are in the business of selling your properties with seller financing, right? We sell with seller financing. If we do this, then there are laws that we need to follow, right? That's what it comes down to, right? And we want to be in compliance, which is a huge reason that you exist, your business exists. Um,
Mhm.
so I just want people to kind of understand that like it's an annoyance in a way to be like, dang it, I can't just go do this a bunch of times and not pay attention to federal law and stuff. So, um, let's can you break it down like a little bit more? Maybe talk a little bit about how Dodd Frank. You mentioned Dodd Frank as like the big federal legislation that
Mhm.
is caused a headache for us people trying to do seller financing. Talk about that, and then how Call the Underwriter kind of comes out of that. Yeah.
Sure. So Dodd-Frank, right, got put into place after the financial crisis. So pre-financial crisis, you had banks and things giving these like no income, no doc loans where the borrower had no ability to repay. And, you know, they would do that because they could package up these loans and sell them to people who would buy them without knowing any better. Now, since then, I would imagine like the investors who buy loans have probably wised up. So even if Dodd-Frank didn't exist, I would imagine that you wouldn't have banks lending like that. In fact, like since Dodd-Frank was passed, the bank lending standards have tightened like way beyond what Dodd-Frank requires. The Dodd-Frank bar is actually pretty darn low. Like as a lender myself, I wouldn't really feel comfortable lending to a borrower who just barely meets Dodd-Frank. Now, my standards aren't going to be the same as a bank, but like it's a pretty low bar overall. Now, the interesting thing about it is the way Dodd-Frank is written, there actually are not black and white thresholds that define if you know the borrower can repay. It defines these 8 elements of the ability to repay, but doesn't actually give you like hard levels, which was super annoying when I first dug into this. Now that I understand it better, it actually kind of makes sense, right? Because you could have, if they set arbitrary lines of, say, like debt to income or credit, the thing is, in underwriting, there are always these like mitigating circumstances, right? So, for example, a borrower might have a high debt to income, but their gross income is really high. So they have a lot of income, left over, or a borrower's credit score might be on the low side, but they got in a car accident and had, medical bills and couldn't work. And, it was like this transient thing that's been fixed. So it actually gives you, kind of some discretion to like look at each file and really figure out what makes sense with it. But what we do is we use some of the government programs as kind of anchor points for allowable debt to income and credit score and things like that. The theory being, if these thresholds are okay with these different government programs, well, then we should know that that's actually compliant. But like I said, the compliance bar is fairly low. Like, really, you need to kind of figure out as a lender, what you're comfortable with and what you want your criteria to be. Like, I'll always give my personal opinion, but based on your model, you may be more or less aggressive than I am.
It's interesting you said that. So like Dodd-Frank, so basically there was a bunch of abuse and not good underwriting done up to the financial crisis. So you had lots of predatory, we might just generally say predatory lending and
Mhm.
bad loans that were not really, like, the borrowers did not have the ability to repay. So then in the wake of that, Congress passes this thing to protect consumers from being lent to or lended to on these kinds of loans. So now it's like lenders have really tightened up since 2008, 2009. It's had an impact on people who do seller financing. But what you're saying is like the what Dodd Frank actually stipulates as like these 8 criteria. They're relatively, it's a relatively low bar compared to a Fannie like Freddie type loan. Can you talk more about that?
Yeah, so the different government programs and banks, right? Like, they have their own standards. You can make your lending standards as tight as you want. You just can't go below this minimum. So, like, one of the things that happens a lot is, banks tend to frown on self-employed people, right? Like, so a lot of the seller finance borrowers are self-employed. They have good income, good credit, they're good borrowers. They don't necessarily fit into the bank's box, right? And so as banks have tightened over time, I call it the seller finance gap, that distance between where banks lend and then the minimum floor, from Dodd-Frank, but they're often good lenders, but they're often good borrowers. The underwriting process is a little more difficult because you're often like going through bank statements and, other things to tease out, um, the actual income, but, they tend to be good borrowers. And then I was going to say something else, and now I just blanked on where I was going.
Well, actually,
Next.
I got 100 questions. We're gonna
Okay.
have to do multiple interviews over time. But so talk about, so well, first of all, I'm gonna ask first question. There's gonna be some people who are like, is a lease an option considered seller financing? I just know some people are thinking that question right now. Like, if I want to
I
do,
I it is and it isn't. So with a lease option, when you put it in place, it's not seller finance, at least right then, because it's a lease. Like, once they exercise that option and you sell them the property, now it is. And those are a little bit tricky because you're entering into this and you got to make sure the borrower's qualified, whatever it is, a year or two down the road, however your lease option is set up. So what I recommend with lease options is underwriting them up front to make sure that they're going to be qualified once they exercise the option. And then once you get to the option period, like, if we've underwritten it up front, it's not a big deal for us to just do a delta for people. I tell people, if you're doing a lease option, just note that when you underwrite it. And then when you come back, when they're ready to exercise, say, hey, this was a lease option you did for me. Can we pull credit again and just do like a quick delta to make sure that, nothing fundamentally changed in the meantime. I've never executed a lease option myself, but you know, um, I would recommend talking to your attorney about, maybe setting that up with some terms that say, one of the conditions of executing the option is that you've got, credit of X and debt to income of Y, just to kind of cover yourself, like, in the event that, something changed and now, it's not going to be a Dodd-Frank compliant loan, because you don't want to be stuck between, do I violate Dodd-Frank or do I violate this agreement that
Exactly.
later, right?
No, that's a sticky wicket on the lease option deals where you've mentioned the possibility of seller financing at the end of the option period or whenever they want to exercise the option. Like that right there, what you just said is like you got to figure that problem out because that is a problem. Like because you can't
Yeah.
because like this is something I've kind of run into is like I can't really promise you this yet because you haven't qualified for it, right? So um you're gonna have to qualify, but yet we want this to work out so that you end up buying it and we sell it on.
Yeah, and I think it's like anything else, right? Like it's just like any other creative deal. You want to communicate as much as possible and disclose as much as possible. So up front, you say, okay, like, here's where you're landing on debt to income and credit, and everything looks good. And have it in your contract, but also just be like really clear verbally, like,
Right.
this is where we need to be to execute this stuff. If you go out and buy two cars and now your debt to income is going to be 80%, or you file bankruptcy, and in the meantime, then you're not going to be able to exercise the option. But I would say for most
Yeah.
people, like if their credit and income are good, it's probably not going to fundamentally change in the next year or two unless they get hit with the medical bills, divorce, job loss. Those are like the three big things that make good borrowers go red. The good thing about those three, though, is they tend to be transient. Like those are
Mhm.
recoverable. But if your borrower has a good track record, you're probably going to be okay. I see a lot of crazy credit reports where you can tell from looking at it because there's so many accounts that have been, charged off and, in collections. Like some people just don't pay their bills.
Right.
And if I'm doing a lease option, I'm not going to do it with a person like that because God only knows where they're going to land in 2 years, even if they're kind of borderline compliant. So with the lease option, I would just make sure it's like no question about compliance, and they're a good borrower that I'm going to want to have, and then just communicate them that here's the expectations. If these things change in this negative way, then we don't get to execute on the option.
Yeah, that's huge. I would just reiterate that uh, communicating that aspect of it, and then if there's any other agreements in there about the nature of repairs, obviously the non-refundable option fee being like, hey, non-refundable. I have an additional addendum for my option contract now that just solely is non-refundable option fee because I just want to draw attention to that, and then I have a
Hmm.
seller finance addendum to my option purchase contract too, because I just wanted like these are the big things here, guys. Like if you fail to um, yeah, if you fail to qualify, you're and if you can't go get a bank loan, then you won't be able to exercise the option. And whatever. I'm more than likely to just like let that ride out until an event happens where they have to move out or they do qualify. But I'm not the type to just want to claw back a property just because somebody
Yeah,
finished.
like I said, like I haven't done a lease option personally, but like if I did and we got to the end of the option period and they didn't like quite qualify, like I'd probably tell them, well, I would look at like, okay, here's what we need to do
Mhm.
for this to qualify, and then like get these things in line, and then we'll do it. Like I would work with them to try to get it to work. I wouldn't just take like a super hard line and start over with somebody else.
That's good. Yeah, you're probably in the wrong business if that's your approach, or you're in. It's gonna work out differently for you than it works out for probably most people.
Yeah.
Um, so describe a couple like maybe like an archetype of the type of borrower like that I'm looking for in my deals or that you might be looking for in your seller finance deals. Is anybody looking to sell? And when we're talking about seller financing, really we're talking about either contract for deed or note and deed of trust slash mortgage, right? So
Mhm.
what are some of the ideal types of like prototypes of borrowers that fit that criteria, like
Yeah, like kind of the prototypical like ideal borrower, it would be like the small business owner, so they're self-employed, but ideally they have like a separate business bank account and they pay their taxes, and then they can give you these like clean bank records to look at, and then tax records that kind of match. And then, they don't have to have perfect credit, but decent credit. Like we use 620 as a threshold, and then borrowers can be lower than that, like under certain conditions. But like, let's say they're like, 650 plus, they've got plenty of income to pay the loan, maybe they've got an auto loan or, some credit card debt, but not like crazy amounts of debt. Like I also see some where, there's the bad borrower type I just described where like they just don't pay their bills. There's another kind that's not necessarily like a bad borrower, but they love to spend,
Mm.
and they'll have like three big car loans and, credit cards and other stuff. And they might have like a lot of income and they pay the bills and that's fine. But that borrower is just going to be like a little more fragile. Like if they hit a hiccup, things are going to get weird for them. So like I like the borrower that's like, you can tell there's kind of somewhat financially conservative. They're not living large, but yeah, maybe they're self-employed and they don't quite like fit the box that banks are looking for. The other ones that are really good are the ITIN borrowers.
Hmm.
Um, like for us, we just need a social security number, an ITIN number in order to pull credit to verify, compliance. But like a lot of your, ITIN borrowers tend to be very financially conservative. They usually have cash around for a down payment. They often have, multiple wage earners in the household, and they tend to be very, very robust. I would say like financially. Now, sometimes the other scenario I run into sometimes is, especially amongst ITIN borrowers, is you pull credit and their credit is like blank and they don't have a score because they haven't really used credit. And that's a million times better than bad credit. It's not really that big a deal, but if they can document their income, they have income. What we'll do is add conditions to look at a couple examples of bills they've paid every month for the last year. So usually people will have, utility bills or even like different online subscriptions, things like that. And you can say, okay, here's examples where this person, they pay their phone bill every month, they pay the power bill every month, they pay rent every month. And we can see, where they have this income. And yeah, maybe they're self-employed as whatever, but you can see everything flowing through the bank statements. Those tend to be really solid borrowers. And those are ones that banks would like generally not deal with.
Right. No, totally. So you're basically establishing credit in the absence of any like real credit history. So you're able to like use a utility bill that they pay on time every month.
Right. Yeah. Cause that's ultimately right. What you're trying to figure out is like, does this person pay their bills? Do they have enough money? Because to me, Dodd-Frank doesn't talk about this, but like in my head, I think of it as the ability, there's like the ability to repay and the willingness to repay. So we look at, income versus all their debts. Okay. Do they have enough money to do it? And then
Right.
we look at their credit and like, okay, then when they have the money, do they actually pay the bills? Because that's not always the case. Right.
That is a great. I like the way you put that. Ability to repay versus willingness to repay. That's gonna stick in my mind now. I guarantee you. I'm gonna start thinking in those categories. That's so because I know exactly what you're talking about. For a second, so let's rewind for a quick minute. Talk about ability to repay in terms of what call the underwriter. Like if somebody is has a deal, they're going to do seller finance. Ability to repay certificate. Like just tell me about that real quick.
Yeah, so we use like as a compliance threshold 57% debt to income, which is pretty high. If I'm personally lending, I want it to be like 50 or lower. So like if I'm pre-screening a borrower and I'm talking to them, I like using 50% because I can do the math in my
Right.
head, right? So like if my P&I is $1,500 and I talk to them and they don't have any, they don't have any car payments or their monthly debts, I'm like, okay, if their gross income is 3,000 or above, like I know they're going to be in the ballpark. Or, if my PITI is 1,500 and they have a $500 car payment, okay, that's 2,000 in debt payments. They need a gross income of 4,000 plus.
Gotcha.
So that's kind of the way I think of it. Now, the other thing, to get into the weeds a little bit, and this is where you get these different like mitigating factors, right? There's this other thing called residual income, which is how many dollars every month does the borrower have left over after they've paid their bills? And sometimes you have to consider that as well. So, like, let's say you have a borrower and they're on disability, Social Security, that's their only income, it's fairly low. They might need debt to income, but if they've got a bunch of kids and they're in a high cost of living area, having that like couple $100 left over every month isn't going to cut it. So you can have cases where the borrower actually has a decent debt to income, but may not be compliant. You may not want to lend to them because they've got 4 kids in there in California, and they've got like a remaining like $500 a month. Like that's not going to work.
Right.
Whereas a borrower could have a debt to income of 60%, but maybe their income is like 20,000 a month, but they've got a boat and they've got like a couple cars and they've got all this stuff. But the reality is like there's plenty of leftover income every month. So we have kind of our baseline targets, but then there's always these mitigating factors. So it's a challenging thing to turn into a hard and fast formula.
Sure. And basically like so if I had a buyer on a house, I'm selling seller finance, and I could try and figure out, oh, what does Dodd-Frank you know, say, what do I need to how do I need to screen these folks? Or I use a service like yours. You're not telling me whether I should lend to that person or not. You're just telling me from because you are an RMLO. I should define that after I say this, what I'm about to say. Because we need to just put that out there. But basically, what you're saying is from an RMLO perspective, yeah, they have an ability to repay. Like that's all that you're able. And with that, then it's actually you're doing a lot more than that. Obviously, you're collecting all the
Mm.
documentation. You're documenting that ability to repay, so that if I decide, yeah, I want to lend to this person, then I can basically go to bed sleeping well, knowing that I'm compliant with Dodd Frank.
Yeah, so the RMLO is a residential mortgage loan originator, right? And so we'll do that underwriting work and figure out Dodd-Frank compliance. And then, if we go through the file and we're like, hey, we're comfortable, this is compliant, then we'll create a certificate that says we've looked at this and we feel it's compliant. Now, there's no such thing as like an official Dodd-Frank certificate, but we create one for people to say that.
Yeah.
Now, sometimes we have files where it's like, okay, to make it compliant, the borrower has these accounts that are in collections that they would need to bring current or get payment plans in place, or they can pay off this debt to bring their debt to income in line. But also, I also will give lenders my personal recommendation of what I can do. Like I've had what they could do. Like I have had files where I've said, hey, listen, if you get the borrower to do X, Y, and Z, this is going to be compliant. However, if you look at their history, they're going to default. And like I personally would not extend credit
Mm, mm.
guy, and I think they have a very high risk of defaulting. Now, usually the lender goes and does it anyways because they're hot to close out the deal. but
Right.
but yeah, I will give my personal recommendations on it. But we're not like unlike a bank, right? Like because sometimes people ask like, well, do you approve this? And I'm like, well, I'll approve it from the standpoint of whether or not I'm willing to write down, yeah, this is Dodd-Frank compliant or not, but it's ultimately up to the lender whether or not to proceed. Like I've had more than a few where I've told the lender, this is not Dodd-Frank compliant, and this borrower is going to default, and I would not proceed with this. And then, they do it anyways. I can't stop them. I just, I could tell them what I think, but I can tell.
Well, yeah, there's a level at which you can only do so much, and so have you ever had like any catastrophes come about from any of the loans that I'm assuming that the majority of them are just smashing successes and people are making a ton of money doing this, but
That's a good
occasionally.
question. Yeah, so it's hard because if the loan turns into a dumpster fire later, I won't necessarily know. And maybe somebody out there has some suggestions. I'm open to this. I'm trying to find because I've got this database of thousands of seller finance loans, and I'm looking for an easy way to find out like which of those have had like a Liz Pendens filing or legal has been started.
Yeah.
Because if I could do that, then I've got all this data on credit and DTI and other things. I could actually build a model. The problem is other than poking through the county records, and I've talked to some title companies about this, and all of them are like, oh, it'll cost you like $70 per file to look it up, which doesn't make sense just to get data points. So I'm not really sure. I mean, I don't know of any specific cases, where
Okay.
ones have gone south. I have seen ones like for sale on paper stack where they've had like the pay history and stuff when they've, looked good. But yeah, unfortunately, I don't necessarily know always what happens, but I'm trying to find that easy way to figure it out so I can kind of go back through and collect that data and tune the model. Cause that would be cool if I could build, a more predictive model. Like I would love to be able to tell lenders, hey, your credit score is 750 instead of 650, and that means your chance of default goes from this to that.
Totally. Yeah.
Yeah, because I've got most of the data. If I just got the like which ones ended up in foreclosure, then I could figure out some cool stuff. Because nobody really has a model like that, as far as I know.
And isn't there also something out there? I don't know if it's in Dodd-Frank that basically like a lender, maybe this is Texas specific because I also had my head in some Texas stuff recently, but where like a lender, if they're going through a foreclosure and then they get challenged by a borrower saying, "Hey, this lender didn't check my ability to repay," but then the lender has so they're trying to like get off the hook or get money or
Yeah.
something from you. um, but then so then like one thing that could get scrutinized from an investor is like how many loans have you um, originated and what's your default ratio? Like do you have a high default ratio or low default ratio?
And that's something attorney generals look at, right? So Texas had the Colony Ridge case last year and actually read that complaint. And like one of the things that Texas attorney general called out, and because Colony Ridge had made like thousands of loans,
Mm,
and I forget what their default rate was, but they called out that their default rate was like 50x the national average. So yeah, if you do have a super, like if you're doing a lot of loans and you have a high default rate, that's something that attorney generals definitely get grumpy about. So, I mean, our approach to that, I mean, it's challenging because if you're doing like one or two seller finance loans, you're not necessarily going to have a huge sample size. So that's why we use some of the government programs as anchor points. So, like, if you're ever challenged, you could say, hey, their debt to income was, 55%, and that falls within this program that uses 57%, and their credit was 625, and that falls within these bounds that use 620. You shouldn't really be challenged. And I think from the compliance perspective too, really the thing that matters most as an individual is really not so much that the attorney general is going to come after you. Because I've looked at a lot of those cases. Like if the attorney general is coming after you, you're doing stuff that's objectively horrible, like at scale. Like you're not in a gray area, right? Like the people they go after, like it's pretty black and white. But I think the more
yeah.
credible concern is just kind of what you said, right? Okay, you have one that does default because some of them are going to default. Event, you do enough, you're going to get defaults.
Yeah.
But then you start foreclosure, and then the borrower challenges and says, "I never had the ability to repay, and they never followed TRID. I never got the disclosures." And if you don't have the 1008 in the package and show that you've sent the disclosures on time, now it's kind of up to that judge's discretion
Mm,
how hard a time they want to give you. Like ultimately, you
mm,
could have, worst case, you could have like an enforceability problem. But if you're like, no, we did all the stuff, we had it underwritten, here's the 1008, here's the whole package, here's the income documentation we have, we did all the stuff, you're going to snuff that challenge, really quick. I'm really surprised that more attorneys don't really, because most of the seller finance loans that are created, people don't do follow any of the rules. Like if I was an attorney that defended borrowers, I would just go around and look for these and be like, hey, I'm going to get you living rent free for a while and be like, well, this was all it, originated incorrectly. They violated Dodd-Frank, they violated
yeah.
TRID, they violated this, they violated that. And it would be pretty open shut. I don't really necessarily see people doing that, but I
Yeah.
think from a compliance standpoint, that's the main thing that I'm worried about. But even that's a little bit of a corner case, really, where the value, really, my opinion, really comes from of having that package is, one of the cool things about owning loans that sometimes people don't realize it's a really can be a liquid asset, right? So you can choose to sell the loan. You can sell a partial against the loan because most of the people who are creating loans, like they're usually doing all kinds of stuff. And so, you might want to sell a loan, or you can sell a partial on the loan. You can say, I want to sell a year's worth of payments because I want some cash to do this thing over here. You can do that. Or the one that I do a lot is you can borrow against your loans and use the loans as collateral. So there's all kinds of ways to turn your loans into money. But kind of the key to that is having the package to be able to show either your buyer or lender or whomever, we originated everything correctly. This thing is compliant. There's not a challenge. And we know that we've got a good borrower and we've done all our homework and crossed all the T's and dots the I's. Like that'll have a radical impact on what your loan is worth. And so to me, the value of that,
Yeah.
is way more than the compliance. People tend to like focus on the compliance. I think there's like fear associated with the compliance,
Time.
but I would encourage people like to focus on the value they're creating by having that, and then all the financial flexibility it
Yeah.
gives them.
There's I mean there's some I wouldn't call them gurus necessarily, but people out in the space, influencers or people just, with the coaching thing or whatever, who like maybe kind of it's to their advantage to stress, like to maybe even maybe slightly fear monger around these topics so that you can buy their compliance package or their whatever this or that.
Mhm.
Your service is amazingly reasonably priced. So but just to learn the information, like people will try and sell you like, oh, you're gonna get sued if you do a if you sell or finance something and don't underwrite it, like they're coming after you, you're gonna lose everything. They can unwind the transaction. And like so people won't even do a deal, like one deal, because they're like, I have to know the whole Dodd-Frank compliance piece of this. So that like is out there. I've encountered that for sure. But
Yeah,
most
for sure. And a lot of the people, honestly, that like get the most wound up about that, like online, are people who are never going to create a note anyways. So
exactly. I
it
know. Like,
doesn't
yeah, yeah.
matter too much. But yeah.
Yeah, so I was gonna go a couple places with that, in terms of well, so there's like a lot of people doing I'm not in the slow flip community, but I don't even really know too much about it except secondhand from people telling me, "Hey, I've been looking at this." And so,
I
um
know I have some client. I know I've never done it, but yeah,
okay,
I'm kind of familiar with that because I have some clients who are doing that. So
that's
my
good.
understanding of the slow flip, and forgive me if I'm off because I haven't actually like done that training. This is just from what I've gathered. But like basically what people will do is they'll go out and just buy a property off the MLS. Usually like a very like low dollar property. Think of like a 50K property in the Rust Belt somewhere, and then they'll just turn around without fixing it up and sell it on owner financing at a much higher price. So they might like say buy for 50 and then sell for 80 or something like that.
Yeah.
And the reason they can do that is the buyer in that case is kind of comparing it to rental rates, right? So like a lot of those areas that have, 50K houses for sale or whatever, the rental rate might be like 7 or 800, whereas you create the seller finance loan and the payment's only a couple hundred. So they're like, this is a cool deal. And there's people that do that just going on the MLS and buying stuff and doing that. Like it does work. I'm not a huge fan of that model personally, just because the borrower's kind of starting off upside down. If they figure that out, that loan's going to be very risky. A lot of the houses in that property range have issues, and if it's like a first time home buyer, they may not understand what they're getting into, or they may not be equipped when they find out like they need a roof or the furnace dies or things like that. So, I mean, it's a fairly popular model. There's others out there that I prefer. Like, because the other thing too to call it is like in seller finance, generally, you are providing a service to the buyer. So, generally, the sale price on a seller finance home is something higher, than a traditional sale. So I think it's fair game, to mark it up like 10% ish, something like that. But when you get into these like really huge percentage price jumps,
Right.
I'm not a huge fan of that
Yeah, you're
model.
setting
It's
your
not something, yeah.
yeah, you're setting your borrower up, buyer slash borrower up for potential failure. And like to your point, if they don't, if they're buying it totally as is, there's going to be deferred maintenance issues that are going to potentially set them up for further failure. But like my bigger concern was for folks doing like a ton of these without using RMLO because like
Yeah, there's a lot of people doing that. And that
yeah,
does, yeah, because that,
makes me
like you said,
nervous.
that's what gets attention of like if an attorney general noticed that, like, hey, this guy did 50 of these and they just marked the price up like 50% and didn't do anything, like what's going on, like they wouldn't be super happy
Yeah, collecting down
about
payments,
that.
not really verifying, and, like, these are high, let's just be honest, those are probably high default types of, I don't know, areas or something. I don't know if that's, fair to say, but, like, I if you're selling in, like, a rental area, like, we know what, like, if you're in a D class area, you're gonna have higher eviction rates. If you're in an A class area, lower eviction rates. So if you're doing most of these in areas where there tend to be higher eviction rates in general. And if your plan is to evict on a contract for deed or land contract, because you can, then all of a sudden you have all this turnover. You thought you were going to make a ton of money. Now I'm speaking out of ignorance. I'm totally could not know what I'm talking about. Maybe it's working fantastically for the majority of people, but I know that for myself and the properties where I hold in like C class areas, higher default rates or higher issues with payments, and so all of a sudden you haven't properly underwritten them, use RMLO, you have a ton of defaults happening. Attorney General comes knocking on your door and then starts cracking down on the seller financing industry. We don't want that to
Yeah,
happen.
the other thing some people do that I don't recommend, somebody just asked me about this morning in a phone call, is there are some people who teach having the borrower sign a deed in lieu at the same time they make the loan. And then the idea is if they default, I don't have to foreclose. I just record the deed in lieu. A friend of mine really dug into that, and that's really not something you want to do because legally the deed in lieu is in effect the date that it was signed, not when you recorded it. So if you actually try to exercise that, say like 2 years later, then technically you owe the borrower back all the payments they made to you because that loan was never valid, from the date that they signed it. So yeah, you want to be, and not to mention, like, I don't know of any specific court cases, but I have to imagine that, if you ended up on court and that and the borrower complained that said, hey, this guy had me sign a deed in lieu and I didn't know what was going on, that any judge is going to take a dark view.
Yeah, no, I mean, just doing proper business, like good business principles seem to always work out well for everybody in the long run.
Well, yeah,
Um,
because the advantage of creating notes, right, if you do it right, is like a good note is it can be extraordinarily passive. Like you sit there and collect payments. And I've bought a lot of existing notes and I've bought a lot of non-performing notes, like at discounts and worked them out. And when you get into these default scenarios, they can be the polar opposite of passive. Like they can be giant time sucks. Sorry, my phone's going off. I didn't turn off the ringer.
one of your
So
buyers right now saying, I'm
yeah.
about to default. No, I'm just kidding.
No, 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 hopefully not. But, so the other advantage of, originating correctly is if you go, especially if you're doing a lot of these, if you're getting good borrowers, creating good loans, well, then all you got to do is sit back and collect money. If you start doing a lot of sketchy loans, even though you have the ability to foreclose and this and that, you're going to be putting a lot of work on your plate down the road that you probably don't want.
Yeah. Yeah. No, I totally resonate with that one. I think that I mean, it's like a timely word for anybody looking at this model, and especially doing these in just lower income, like those $40,000 properties. It just makes me nervous, man. Like I know it's gonna happen. It's just not likely gonna end well. Prove me wrong. But like talk real quick, like land contracts though, in particular, because or contract for deeds or bond for deeds. They're called a bunch of different things, but hey, that's not seller financing, is it? I don't need an RMLO for to do that,
Oh,
do I?
it totally is. So this is a funny thing. So last year at some point, I'll have to find the link, but the CFPB actually came out with a statement that said all the consumer rules that apply to mortgages and deeds of trust also apply to land contracts. And I thought that was really weird because I had always been, because I've bought a lot of existing land contracts and had to do forfeitures and foreclosures on them. And my attorneys have always advised me that, oh yeah, the same rules apply. Well, the legal process to take it back might be different if it's a state where you can do a forfeiture. But as far as like if you're originating one, having to do the disclosures, the different limits on fees and etc., like all those same rules apply. But yeah, the CFPB made that explicit. And then once I took on Call the Underwriter, and I realized how many people thought they didn't apply. Yeah, no, they
Yeah.
absolutely do. And so for people who aren't familiar with those, think of them as kind of like, on one hand, they're like the same as a mortgage or a deed of trust. The borrower is buying the property. They have full rights to the property. You, as the lender, you can't just go in and inspect things. It's theirs. But it works kind of like an auto loan where the lender holds on to the title. And then when the loan's paid off, the lender sends over the title. So, sometimes, and then depending on the state you're in, if the borrower does default, it could be a faster and less costly legal process to get the property back. So that's one reason lenders like them. And then because the lender is still on title, sometimes people like to use those, like if they're doing a wrap loan, to try to avoid triggering a due on sale. A lot of the states are really down on those. Like I know Texas changed some rules. I don't know if they're technically illegal, but I think they're like some states have made them like de facto illegal because they're like harder to enforce than a mortgage. And then in Pennsylvania, several years ago, they went after this company called Harbor Portfolio that made a lot of these. So I think eventually there's something that might, kind of go away. But yeah, the same consumer rules apply. Now, if we're talking like 1985, yeah, it would be different, but that's not where we are today.
Right. Yeah. It's crazy. Like having gotten to know some folks in my local market in St. Louis, and having met, there was one big realty group that did a ton of like wraparound transactions in the 80s, 90s, and came crashing down in a massive way. I'd never heard about them until I was walking a house that a realtor, it was like a pocket listing, was showing me and was asking me about my exit strategy. And she's like, "Oh yeah, wraparound mortgages. Like, yeah, I used to work with a company that did a ton of those. Totally
Oh
tragic
no,
story. They were defaulting on all their underlying loans, and they're
yeah,
like they were foreclosing on their borrowers. Like it was a
yeah.
crazy
There's lots
nightmare.
of room. Like as a lender, like creating a land contract or contract for deed, there's a lot of room for bad behavior, and that's one of the reasons why states don't like them. But yeah, they're and doing wraparounds is nothing new. Like when I was getting my will put together recently, I was talking to my attorney and I was telling him what I did, and I mentioned something about wraps, and he goes, "Oh, people still do those?" He's like, "I created a ton of those here in Colorado, like in the early '80s." He's like,
Hmm.
I created a bunch of those." And I'm like, "Yeah." So
Hmm.
it's th- that's the other thing with creative finance. Like a lot of the stuff is considered, kind of the sexy thing, but none of this is actually new. Like all the stuff people are doing now, like sub twos and stuff. There were people doing this stuff like 45 plus years ago. Not as many maybe, but yeah, none of the
Right.
stuff is actually like that revolutionary.
Yeah, no, no, it's not. But like, yeah, also living in the wake of some, case law and legislation. I feel like, yeah, it's an interesting dynamic where people have no idea what I'm talking about, but it's been around. Or, yeah, like you said, oh, people still do that, like the old timers, and it's like,
Mhm.
yeah, but that's cutting edge. Nobody else is doing this.
Yeah.
It's an interesting space, and actually, like that leads into another question about just the note buying space,
Mhm.
the private note buying space. Like, why do you think that people over here in the creative finance world, sub two and everything, like my experience is that they have no idea that you guys over here exist, and then we're over here buying sub two and wholesaling the deals and doing lease options, sometimes contract for deeds. Sometimes there are some people who know, but like most people have no idea that, hey, if you sell on seller finance, you're creating paper that you could sell. Like you could actually tap it like equity. People can
Mhm.
buy it. Like the note is an asset. Like why do these two communities not know about each other?
I'm not really sure. I mean, I would say the note buying community is fairly small for whatever reason, and my hypothesis on that is maybe that, if you're going to be buying notes, generally you need your own capital to do that, which if you're doing it in a retirement account, like most people have the funds, to do that. I think sometimes people are more attracted to the creative finance space because there are ways to, make money without necessarily needing to have a nest egg to start with. But yeah, of like the individual note buyers, on the whole, there's not a ton of them out there. There are a number of like institutional note buyers that'll buy your seller finance notes, but they don't really advertise much like outside the note buying community, so they don't make themselves like as well known in the right places. So I think part of it is just the note buying community being too small and kind of
Hmm.
stuck in their ways. And the other interesting thing I've observed is the behavior patterns. Like the note buying folks, for the most part, I'm generalizing here, tend to be very kind of conservative, slow moving. Will look for like any reason not to take action on a deal, whereas like the creative finance community is like the polar opposite, probably over rotated the other way. Like the note creators tend to be very aggressive, and then once they get something figured out, they just go ham and start doing a lot of them. But yeah, I haven't quite cracked the code on why so different, because there should be just this natural like thing where they know each other and people are creating notes and selling them to the note buyers. Because it's funny, you go to the note buyers, their number one complaint is they can't find supply, which is absurd because there's so many loans
Yeah.
out there.
Yeah, that does seem crazy. Like I've been approached a few times by people who are like in the notes space, it seems, or they're farming, they're marketing for notes. Like it's been, but only a few times, and typically it's off of like a Zillow ad that I have a property I'm advertising for sale with seller financing, and so they might reach out and say, "Hey, I'm buying notes. Do you have anything available?" But
Mhm.
even their follow-up game is pretty weak because I hear from them one time and then it's like, "Man, like, is there opportunity in this space to be like to take the same rules of, marketing tactics of, like, wholesalers," which I've done a little bit of, and, like, go out into the note space and just start, like, getting these people like me with a small portfolio of contract for deeds and wraps and stuff and like, "Hey, do you wanna, like, sell those and capitalize on those? Like, I might be able to connect you and, um,
Yeah,
is there
I
opportunity
think
there
I
or
think
no?"
there is. Yeah, I think there is opportunity there. Just one of the challenges is the note buyers tend to move so slow, so you can't be in a hurry. It just takes time to kind of put
Okay.
the whole thing together. But yeah, the market's very like opaque and like illiquid. So there is opportunity there to connect buyers and sellers and kind of smooth that out. Like way too many note buyers are content to just sit on cash. They'd rather sit on cash at 0% than not get a killer deal when they buy.
Interesting.
Yeah.
Interesting. Yeah, I've yet to sell a note, but, it's on my to-do list for, like, this next year, so I just do it just to do it. Like, if it takes creating, like, a first and a second on a wrap or something,
Mhm.
I'll sell the first type deal. Um,
Yeah, I mean, if you're creating good paper and you can sell to a more institutional type buyer, like First National Acceptance in Michigan will buy a lot of seller finance paper, and Melody Bank in Texas. Now they've got like tighter buy boxes, but if you can fit inside their buy box, then they'll tend to pay more than anyone else because those are banks and they have very low costs of capital. Um, Whereas like a lot of individuals, you know, it's a little different. They either have high expectations or, they're using outside capital that's more expensive, so they're more price sensitive. That's all the more reason why, and like First National Acceptance, they won't make an offer on a loan unless you have the TRID disclosures. So, if you originate and you don't follow the rules, like they're not even an option. But if they are an option and you fit their buy box, well then they'll pay you top dollar. And they buy a lot, so they're a little bit easier to work with. So I've had way too many flaky people like I'll accept an offer from them and they'll dork around for like a month and then flake out. And that's super annoying because now I'm starting over.
Man, that's interesting. Yeah, that's super interesting. So, I mean, so when you talk about hypothecating a note and borrowing against the future cash flow, do you are these individuals are these institutional folks who are
No,
interested? Or are these
when I
private?
do it, they're individuals. It's usually people lending out of a self-directed retirement account. So it's usually like they have cash in their retirement account. They want to put to work. And then I know we got a hard stop in a couple minutes, so I'll keep it quick. But like what I'll do is like I'll go out and buy a loan that maybe has a little hair on it. Let's say like a 12 to 15% return. And then I'll take a loan from an investor at like 8 or 9%. And so that creates a little bit of a spread. Not huge, and then for me, since like a lot of these I'm buying on the market at some discount, these are generally like existing loans. I'm buying, then if the borrower happens to refinance or pay off early, then I gain that difference and pay the. And if you do enough of them, those little bits of monthly cash flow kind of add up. So
Oh, definitely. Yeah, and it's a way to avoid the discount if you actually were to sell the note, right? Kind of is
yeah,
that?
exactly. So, and then I know, like, I got a hard stop in like 2 minutes, but
You'll wrap it up.
getting on the next one. But yeah, like I've seen loans, like really like high quality loans, big down payments, like good credit, actually sell above par. Like there was one a while back, somebody sold it for 102%
Wow.
of the balance. Now that's rare, but
Yeah.
it can be done. But then I've also seen ones where, it's kind of like it's compliant, but it's kind of sketchy borrower, small down payment. And then that institutional buyer, like they'll buy it, but they're going to discount it down to like a 15% return.
Mm.
Right. So if you created that loan with a 9% interest rate and it's got a 30-year term, like that's a huge haircut if you want to sell that loan. So the difference in pricing you can get can be dramatic. And so that's why I emphasize like taking your time, find the right borrower, like pre-screen them, because it
Mm.
makes a huge difference in the value you're going to have.
Man, that's crazy. Yeah, I think it'll blow people's mind just even learning that they can actually capitalize today by cashing out some of the future cash flow with like a private investor on their note. It's crazy. People, um, if they need cash now, you can still do it with a seller finance model. You don't have to go out and wholesale. But anyways, Dan, this was so great. Tell people how they can find your website and reach out to you.
So you can find me at calltheunderwriter.com, or if you want to drop me an email, you can just email me directly at dan@calltheunderwriter.com.
Excellent. Highly recommended if you're doing seller financing in any capacity, man. Thanks again for joining us. And it was a pleasure talking. Have to do it
All right,
again.
thanks a lot. Appreciate it.
All right. Peace.